Welcome to the NAIFA webinar series, providing you with timely information and training on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today we are presenting Business Planning with Life Insurance. With me today is Michael Stabe. Michael is an insurance wholesaler, consultant, CE instructor, author, and advisor. In July 2012, Michael created his own BGA, which is Stabe Brokerage, to serve and support advisors in providing their clients with the best possible solutions. After growing the firm for 2.5 years, he joined forces with the local established firm, Washington Brokerage. And now each of the two firms' strengths are combined in the areas of practice development, planning strategies, training, and joint casework to support their advisors. And Michael has a long volunteer career. He has served as president of NAIFA Seattle East Side and as the Region 6 Vice President, Communications Chair, and was the 2014 State Convention Chair for NAIFA Washington. And today Michael is going to show you how life insurance can be a valuable tool for your business owner clients, beginning with the basic buy-sell plan, and Michael will then move to more complex uses such as deferred compensation and estate equalization. And during the webinar, you may type questions on the question box on the right side of your screen. All questions will be answered during the Q&A session at the end of the webinar. So let's begin. Welcome, Michael.
Thank you, Brandon. Good afternoon, everybody, particularly to those of you like myself on the West Coast for spending your lunch hour with us. Before we get into the presentation, I want to talk a little bit about my NAIFA experience. I've been a member of the organization since 2009 when two colleagues of mine approached me and said, we'd like for you to join us on the board and add your experience and expertise. And my response to them was, well, I should probably be a member first, so let's start there. And so I've been on the NAIFA Seattle East Side board ever since. This June, I'll be finishing my second term as the local president. And probably at some time in the next 5 or 6 years, I'll make a run for going up to state chairs as well. A couple things about my NAIFA experience that I wanted to share in particular and what NAIFA has done for me, aside from all of the hugely valuable advocacy work this organization does, I wanted to share with everybody two things that have made a significant difference, not only in my career, but in my life. Because of NAIFA, the relationships I've made, and in particular, the Leadership in Life program, Lilly, I graduated in 2010. I met 3 gentlemen who have become not only some of my closest friends, but 3 gentlemen who have helped me through difficult times in my life professionally and personally. Lilly also made a fantastic improvement in my relationship with my spouse and my family. And probably the most significant business part, aside from Lilly giving me the skills to start my own firm that I did in 2012, is that I met a gentleman, one of the 3 gentlemen I mentioned before, and together we worked on what, at least so far, has been the largest case of either of our careers, and probably will be the largest case of our careers however much longer we have left. We were working on a case where it was a life insurance to collateralize a business loan. The amount of insurance the business owner had requested from us was $1 billion. That's a billion with a B and all the zeros that follow after that. Unfortunately, the loan fell through at the 11th hour and we didn't get to place a single dollar of insurance, but it was a huge learning experience for both of us. I got to find out how much capacity really exists in the market and try and come up with some creative ways to get as close to that $1 billion figure as possible. I'd be happy to answer any questions on that at the end of the presentation. But let's go ahead and jump in. So as Brendan mentioned, I've been in the business and the wholesale side of the business for the vast majority of my career, 15 years at it, actually coming up on 15 years this summer. I actually was in the business prior to that, in a more informal role. I'm a 3rd-generation insurance wholesaler. My mother's a well-known disability insurance expert. My late grandfather was a general agent for a P&C firm in Northern California. One of his big first clients was the Mondavi brothers, back when they were the Mondavi brothers and not Robert Mondavi and whatever his younger brother is doing. So we have a long tradition of being in the wholesale side of this industry. I love this business. I'm going to be in it as long as I'm able. And business planning is one of my biggest passions. So I want to start with a couple statistics. I'm a bit of a numbers wonk and a product geek, and proud of those two terms. In 2012, Harris Interactive did a study. 36% of growing businesses have an exit or continuation plan in place. Any kind of a formal plan, whether it's written or not. 36%. So that means the other 64% of businesses out there have no plan in place for what happens in the event of a death or disability of an owner of that business. Of those that do, that 36%, only 2 of them out of every 10 have a plan that accounts for the owner's death. And only half of those have a plan that accounts for an owner's disability. My point here is that there is a massive underserved need in the business owner environment for the types of products that we deal with. My mother being in the disability business, I know the disability business well. I will always advocate for it, but my passion lies on the life insurance side, which is what we're going to talk about today. As with any presentation, you've got your disclaimers, disclosures, and common sense nonsense. So that'll be in the presentation that you get as a follow-up if you want to read all of that jargon. So the topics we're going to cover today, we'll talk about business valuations briefly. We'll get into different types of buy-sell agreements, what true key person is. We'll talk about what many business owners who approach an advisor, they ask for key person. 9 times out of 10, they really don't mean key person. We'll talk about what that means. We're going to get into executive bonus and deferred compensation plans, succession planning, exit planning, and estate equalization. So first and foremost, business valuation. There's a couple questions that are good door openers for talking to business owners about what they're going to do. After you establish whether or not they even have a plan for the death, disability, or even retirement, another trigger there, of these business owners and how they're going to exit. The next logical step is, what do they think the business is worth? Principal Financial Group did a study a few years ago, and their results said that half of business owners surveyed undervalued or overvalued their business by as much as 50%. So if they asked a business owner, what do you think your business is worth? The business owner said, I think my business is worth $2 million. Half of the time, it was worth $1 million or $4 million. So business owners really don't necessarily have a great grasp on what they're doing. For that other 50% who do have a good grasp, another door opener you can do is, have they ever had a third-party valuation performed? And Principal and a couple other companies out there do have valuation services that they offer to advisors, usually at no cost. These are, of course, informal valuations, not something you would want to take to an IRS hearing or a legal proceeding of any kind. But it at least gives you a third-party opinion on how much that business is worth. There are, of course, services out there, and many CPA firms in the business market do offer formal valuations, which for your larger business clients can actually give them that third-party documentation. Some of these companies also offer buy-sell agreement review. They can do a third-party review of all of the terms of that buy-sell agreement, and one of the most important sales parts of that is they'll point out, is this trigger, such as death or disability, funded? Is there insurance to back this up? One of the number one things that comes out of some of the buy-sell agreement reviews that I've seen over the years is that the disability trigger written into the buy-sell agreement does not match the disability definition in the disability policy. Obviously, on the life insurance side, life insurance is pretty binary. You're alive or you're not. But disability, there's a gray area. And you don't want your clients to fall into the black hole of the disability trigger in the agreement of the buy-sell agreement is triggered, but the disability benefit on their insurance policy is not. Then that makes that disability policy nearly worthless unless that disability becomes greater. On that second question there, have you ever had a third-party business valuation performed? That same study I mentioned earlier from Harris Interactive in 2012, 62% of business owners had never had their business valued. by themselves, by their attorney, or by an impartial third party. So in my opinion, business valuation is a great door opener to talking to your clients about not only buy-sell planning, but then as a door opener to some of the other topics we're going to talk about. So first and foremost, let's talk about buy-sell agreements. There's three basic types: cross-purchase, entity purchase, and trustee purchase. We're going to go through each of these one by one. First up, cross-purchase, hands down the most common type of buy-sell agreement. In the next scenario, we're going to talk about John and Mary each are 50% owners of this business. In a traditional cross-purchase, John buys a policy insuring Mary's life from the insurance company. John is the owner and the beneficiary. Mary is the insured. Mary does the same thing. Mary purchases the policy and John, vice versa. Let's say in the event of John's death, Mary receives the life insurance proceeds from the insurance company and then uses that to purchase John's share of the business from his estate. There are 12 states in our country which have community property, my own Washington being one of them. A problem with a cross-purchase buy-sell agreement is that ownership of a business, unless acquired prior to a marriage, is considered community property. There are, of course, legal ways around it, but generally, business equity is considered community property. A good good business planning attorney will write a clause into the buy-sell agreement that the spouse, the non-working spouse, or I should say the non-business owner spouse, agrees to this buy-sell arrangement as we've discussed. So for those of you who are in those 12 community property states, most of those business attorneys in those states should already be doing that, but it's something to look out for when you see these buy-sell agreements. So what's the problem with traditional cross-purchase? Let's take that same example before, but let's say we have 4 owners: John, Mary, Olivia, and Brian. In a traditional cross-purchase, John would go to the insurance company and buy a policy on Mary, Olivia, and Brian. Olivia goes to the insurance company and buys a policy on John, Mary, and Brian. And it goes on. And in the end, we have 12 different life insurance policies insuring these 4 owners. While this is great for our sales numbers, it's not necessarily easy for the clients to administer. The easy answer here is doing an entity purchase. In an entity purchase situation, the business entity is the policy owner and beneficiary, goes to the insurance company, and purchases a policy insuring each owner for an amount equal to their own ownership equity. So in this situation, let's say Mary is the owner who passes away. The business has paid the proceeds on Mary's policy, and based on the terms of the buy-sell agreement, Mary's estate sells her interest back to the business. With John being the sole owner of the business still living, he now owns all shares of the company. So let's look at the third design. In a trustee purchase, you have a separate trust entity that acts basically in the same way that an entity purchase does. We've got the same policies purchased. Same thing happens when when an owner dies, but a trust acts as the entity that keeps all the policies and handles the transactions of changing ownership. The big reason that trustee purchase is used, particularly in larger companies or companies with a lot of liability exposure, is exactly that. It's liability exposure. Any assets in a trust, including the life insurance insuring the buy-sell agreement, or disability insurance can also be in a trust, is not an asset of the business and therefore is not subject to the creditors of the business. So for example, the last time I did a trustee purchase, it happened to be a nice sized construction company that I believe had about 15 or 16 partners. So first of all, the trust gave easier administration for having policies on, well over a dozen owners. Also made it easier to adjust those as ownership percentages changed, as owners came in and transitioned out. But it was more for if the company ever got sued for any sort of a construction problem by someone they were contracting for, any of those ownership percentages and policies insuring those ownership percentages were outside of the assets of the business and therefore not subject to any of those creditors. All right, so we've covered buy-sell. Let's move on to key person. Like I said at the top of the presentation, many business owners who come to a financial advisor or an insurance advisor asking for key person insurance, very commonly they're actually talking about buy-sell insurance. They perceive any sort of business purpose life insurance as key person insurance. So what is a real key person? A real key person is that rainmaker. It's that person who is going to, the loss of that person is going to have a significant impact on the future success and income of that business. We're talking about sales leaders, people with specialized skills, people with key relationships that are important to the clients of that or the customers of that business. One downside, and I've run into this a few times over the years, most insurance companies from an underwriting standpoint will only insure a key person up to 10 times total compensation. And I emphasize that total compensation because some carriers will take into account not only salary and bonuses, but they'll also look at, do they have any stock options? Do they have any other sort of high value bonuses that they're being given? You know, deferred compensation, which we're going to talk about in a few minutes, is another thing that you can factor in to that formula. So obviously, the main thing there for key person is that for that business owner to use the proceeds of that lost person to replace the income that they lose from the loss of that person, or to find the time to find a proper replacement for that person. You know, I mentioned the example of someone with specialized skill. If someone has a specialized skill, you might have to hire someone at a premium to get them into that business to keep the business going. And the life insurance proceeds from a key person policy can be used to do that. One example is my mother and I worked together on life and DI with an advisor here in the Seattle area who was insuring a particular, I won't get into the industry, but this particular person was in a business that was very highly specialized. There was only 6 people in the world who had the right level of skills for this particular job, and this one particular woman insured 5 of those 6 people. So we were putting very high amounts of coverage on these people because their skills were so specialized. So now let's talk about executive bonus. Many of us have probably heard the term golden handcuffs. This is usually what we mean when we're talking about golden handcuffs. An executive bonus is something where you, the employer, or your client, the employer, can say to their top employee or their specialized people, I'm going to put this plan into place, and if you stay with me for X number of years, or whatever terms they want to put in, you'll get this bonus at the end. That's why we can call it a stay bonus. So in one example, I have another advisor here in the Seattle area who's looking at doing this for a gal who works for him, and who basically is the reason that he's become as successful as he is. For those of you who have an assistant, a good assistant can be worth their weight in gold. And there's no reason, even us in the industry who are doing these types of policies, we can't do some sort of a golden handcuff or stay bonus for our key people. It makes it even better when we're proposing that to our clients who have key people that they want to keep around too. I'm going to hold off on talking about deferred tax deduction because we're going to get into deferred compensation next. And the deferred tax deduction is something that applies to executive bonus and deferred comp. Now, deferred compensation is a little different from stay bonus. You may have heard the term from in the business of non-qualified deferred compensation. And in a true non-qualified deferred comp plan, you usually want a certain number of participants, ideally 10 or more, because then you get underwriting concessions at 10 lives or more with many carriers. And one of the big upsides to it being a non-qualified deferred compensation is you're not subject to contribution limits like you are in qualified plans. For example, if you've got clients who are contributing to a Roth IRA, they're limited to $5,500 subject to an income cap. Or if they're contributing to 401ks or other types of qualified savings plans, there are limits on how much they can do. For highly compensated employees, you can layer non-qualified deferred compensation on top of that, and it allows that employee to say to their employer, all right, don't pay me a certain amount of my income per year. Instead, put it into this non-qualified deferred compensation plan, which will accumulate over time, and I will contribute to you by deferring a portion of my salary or my bonuses or whatever amount until a later date. One of the bonuses for the employer is that it can be a discriminatory plan. Now, one of the common questions I get is, what do we mean by that? In a discriminatory plan, the employer can say, I only want people with 10 years or more experience, or people who are upper management or higher in the company. So you have to basically draw a line on the hierarchy within the company and say, anybody who meets this threshold or greater can participate in the non-qualified deferred compensation plan. Anybody else cannot. Deferred compensation is not available for rank and file employees, mostly because rank and file employees should be using some form of 401k or other employer-sponsored qualified plan. Another benefit for the employer is in the deferred compensation, they can set up their own vesting schedule. For example, you can say to your employees as an owner offering a deferred compensation plan, if you choose to participate in this plan, you can be vested at 10% per year over the next 10 years. Any contributions up to that point or after are fully vested once you reach 10 years. And that's just an example. The employer can say, pick whatever vesting schedule they want. The vesting schedule can even be tied to performance thresholds. If you can say, vesting hits 100% if we reach X sales goal. Because it's a non-qualified plan, you've got far more choices in how you design it than you would in a qualified plan. An employer can also elect to do matching or other types of ways to incentivize their highly compensated people to participate. Let's talk about that deferred tax deduction. So let's say you're an employee whose employer has offered you a non-qualified deferred compensation plan. What's the biggest benefit to you by saying, all right, don't pay me 20% of my income and let me get that later on in life? The benefit to you as the employee is, guess what? You don't pay taxes on that in that year. You don't pay taxes on it until it's distributed to you. What does that mean for your employer? That means they don't get to deduct that portion that you've elected to defer as compensation in that year. But they get to deduct it down the road when you elect to start taking it out. That's what we mean by deferred tax deduction. We could spend an hour just on deferred compensation. There's all sorts of neat things you can do with that. And many of the carriers you're working with have deferred compensation systems that you can talk to them about. But for the purposes of this program, we're going to just keep it to that for now. Next, let's talk about succession and exit planning. One of the probably least used purposes of a buy-sell plan is for passing on business to the second generation or the third generation. I'm sure we've all seen statistics over the years of how many businesses survive the second or the third generation. The numbers are miserably small. I believe the last time I saw a statistic, and don't quote me on this because I haven't looked it up in the last couple of years, but I believe businesses that made it past the second generation, I think it's 15%. And I believe once you make it past the third generation, it's down to 5 or 6% of businesses survive that. So one of the ways we can make that easy is, I've worked with a farming family here in Eastern Washington, where they were looking to pass on the family farm to the next generation, but the owner, who was the mother and father, did not yet want to give up ownership or death. So what you can do with life insurance is you can set up a life insurance policy that, so let's say you've got a husband and wife where the husband is the active person in the business and the wife either has a job outside the home or is doing something else unrelated to the business. You can put insurance on that father figure, the beneficiary being the second generation. Let's say their children are going to take over the business. And what can happen at the trigger of that person's death, that benefit pays to the kids. The kids then use that money to buy the business, lock, stock, and barrel, from the surviving spouse, their mother. benefit, of course, is the kids get the business without having to take out any sort of a loan to buy it from their mother, and the mother gets the cash value of the business, which she can use as her retirement nest egg. Next, I want to talk about estate planning and estate equalization. Life insurance, has a reputation for being there for the people who have large taxable estates. And I want to give you an example of a taxable estate, or excuse me, an estate that was not taxable. This is a real case we did about 4 or 5 years ago. It was another family farm, this one located in the Midwest. The daughter was active with the family farm. The family farm was valued at about $6 million, which at the time was subject to a very small estate tax. Obviously, with today's estate tax exemptions, I believe it's $5.43 million per person, double that for a married couple. A $6 million farm is not going to pay any sort of federal estate tax. But the daughter who wanted the farm had a brother. That brother was a high-powered attorney in Seattle who had no interest in farming. He was an attorney in the tech industry, independently wealthy, had no interest in the farm. But like many attorneys we know, and I hope there's none on the phone right now, lots of attorneys are a little on the greedy side. I'm not saying they all are, but many are. That attorney wanted his half of his parents' estate, but he wanted nothing to do with the family farm. So what we did for them is we put a $3 million survivorship policy on the two parents. We made the daughter the beneficiary, and at the parents' death, based on an agreement the entire family signed, the family farm would pass 50% each to the two kids. Daughter would then use that $3 million life insurance proceed to buy her brother's half of the farm. Obviously, we had the same outcome there as I did in the last example. The daughter acquired the farm with no debt incurred, and the son, the attorney, got his $3 million. So we can't have any kind of a life insurance conversation without talking about tax. And I put this in all of my life insurance presentations. I've been teaching CE since 2007, and taxes, I think, are an important thing. We need to know about them. We may not necessarily like them, but we have to know them. And it's a common question we get from clients. So first and foremost, death benefit is income tax-free. Capital gains, not applicable to the death benefit. And the death benefit is exempt from estate taxes when it is owned by an irrevocable trust. Otherwise, any life insurance that is individually owned is included in taxable estate. Cash value while inside of a life insurance policy, exempt from all forms of taxes, at least under the current tax code. Congress, being as fickle as they are, can of course change that. Cash value when distributed from a life insurance policy, as withdrawals, they are exempt up to the cost basis, which is cumulative premiums paid, and then become subject to income tax in excess of cost basis. Cash value distributed via loan is not subject to income tax, provided that the policy remains in force. So let's look at a few different situations when one of the entities listed on the right, the business owner, employee, or employee, spouse, or family, is one of these entities on the left, the insured, policy owner, premium payer, or beneficiary. There is a situation in here in which the tax treatment of the death benefit in particular changes. I'm going to highlight that here, and then we'll explain why that is. When the business entity is both the policy owner and the premium payer, but the employees or the insured's spouse or family is the directly named beneficiary. This is a situation that if you come across, I highly, highly recommend you talk to your clients about fixing this immediately. Because what this means is that business entity, which is the owner and payer of that policy, is effectively giving that beneficiary, the employee's surviving spouse or family, whatever the death benefit is. That results in the death benefit being subject to income taxes, and a big one. So for example, if you've got $1 million death benefit, nearly the entire million becomes taxable to that employee's surviving spouse, assuming that they're the named beneficiary. If you have a benevolent business that wants to buy more than, say, a group insurance policy on their employees for their own personal use, the business should not be the owner. They can be the payor, in which case that employee does need to be taxed on the premium amount. Basically, that premium amount being paid on their behalf is considered an employee compensation. So, for example, if it was a $1,000 annual premium, the employee would have to pay the taxes on the $1,000, even though the employer is paying that $1,000 premium. That prevents that death benefit from being taxable. Important situation. I haven't seen it come up a lot, but many business owners, they want to be the owner of everything that the business is paying for. In the case of life insurance, they should not be for this reason here. So next, the other big one, taxation of life insurance premiums. This is another slide I put in all of my life insurance presentations because it's still to this day something that comes up a lot. Life insurance premiums are not tax deductible under any circumstances. As with anything, there are exceptions to the rules. Employer-paid group, up to $50,000 of death benefit per employee. The employer can deduct the premiums for that group plan. Any employer-paid group in excess of $50,000 can certainly be tax-free to those employees, but the employer cannot deduct the premiums for amounts above $50,000. Also, life insurance inside a pension plan and life insurance inside a captive insurance company. Those are the only three exceptions to that tax deductibility statement. So for all intents and purposes, life insurance premiums are not tax deductible under any circumstances. Next, I want to talk about Internal Revenue Code Section 101J, employer-owned life insurance. This is a big one. I just gave this presentation, I've been doing this particular presentation for 4 or 5 years now. I hadn't given it for a while and gave it just this last month in February, and we spent probably about an extra 20 minutes at the end of my presentation talking about this. So I've expanded this section of the presentation to address a lot of the usual questions I get. So this was passed as part of the Pension Protection Act. And you may have also heard it referred to as COLI best practices or EOLI requirements or PPA rules. And what Section 101J applies to is any life insurance policy insuring an employee and owned by a business. It was issued on or after August 17, 2006. The law requires that notice and consent be acquired from the insured, who is also the employee, no later than the time of application. The impact of noncompliance is significant. If the notice and consent requirements are not met, the death benefit payable to that employer, that business entity, is subject to income taxes. All of it. So that $1 million key person policy on your specialized skilled person who did not consent to it in writing, in compliance with this rule, can be subject to 100% income taxes, or excuse me, I should say 100% of the death benefit subject to income taxes to that employing entity. So what do we do with non-compliant policies? How do we fix that? One of the big questions that came up in my presentation last month is, what do we do when we come across new business owner clients of ours that have in-force life insurance? Again, put in force after August 17, 2006, that was not done in compliance with 101J. The only way to fix this is to replace it. You cannot retroactively do a notice and consent. Now, I have heard of situations where an employer has done that and an employee has agreed to it, but as the law is written, the only way to fix it is to replace the policy with a new policy that is compliant. Now, one interesting part of this law is who the onus is on to document it. And it's not the insurance company. An insurance company is not going to be penalized by the IRS because a business owner did not do the proper notice and consent requirement. So it is important to talk to business owner clients about this. Briefly, I want to cover what needs to be in a proper notice and consent. It must be in writing, it must list the maximum base amount that the employer might apply for. It must state that the employer will be the beneficiary of the policy. The insured must sign that they consent to these terms, and they must consent that the policy may be continued after their termination or separation from the company. And one important point here is this still applies even if the proposed insured is an owner of the business entity. So Michael Stave LLC is taking out a policy on me. I still have to consent, even if I'm the sole owner, as long as my business entity is going to be the policy and beneficiary. There are some safe harbor requirements or safe harbor options that 101J includes. And for a policy to be compliant with 101J, there are two things that have to occur. One, the notice can consent. Actually, let me back up, I should say three. The notice and consent must be done no later than time of application. It can certainly be done earlier, but no later than time of application. And one of these four safe harbor provisions has to be met. This person must be a documented key person. And one of the follow-up documents you'll get from me will include a list of how the IRS defines the key person for this purpose. They must be a current employee at the time of claim. The death benefit can be paid to the insured's heirs, or the proceeds must be used for buy-sell funds. Now, let me back up a little bit to recap that. Notice and consent must be performed, and one of these four must be true. Now, record keeping for these four safe harbors varies a little bit. For example, 2, 3, and 4 are only things that would be documented at the time of claim. Key person must be documented at the time of application. And the IRS states that if you're using the key person safe harbor for employer-owned life insurance compliance, you may be required to prove it at claim time. Even though you must document it at application time, your employer or client needs to keep that documentation until claim time, because they may need to prove it if the IRS asks for documentation that they were a key person at the time of application. Now, annual reporting requirements. Form 8925 came out at the same time as this regulation. The reporting requirements form must be filed every year by the employer. The form is very simple. It simply asks how many employees do you have life insurance on, where you, the employer, are the owner and beneficiary. What is the total amount of coverage of all of those policies? You don't have to disclose the individual amounts, just the total amounts. And the third part of that form is how many employees do you have insured who have not consented to be insured? Obviously, one of the problems that that particular piece opens up is, okay, so how is the IRS going to find out if you're not compliant? That's the question I got at the recent one. And my answer is currently there is not an automatic mechanism that I'm aware of that the IRS has for confirming this. But do you want to be, do you want your client to be the test case in IRS court to prove whether or not you did it correctly? So I would strongly recommend do the compliance steps with your clients, make sure it's taken care of appropriately so that you're not that test case. All right, so that's the biggest part. We're going to open up for questions in just a minute. I want to do my little quick commercial here. There are two publications that we put out on a regular basis at Washington Brokerage. We have our Advisor West newsletter, includes articles that myself and other folks at our firm write, carrier and product updates, notable ones, not all of them, but the ones that seem most significant and impactful. Some of our more advanced sales ideas, upcoming webinars, conference calls, and events. That publication goes out once a month. Our second most popular publication is our Fast 5 Weekly Sales Ideas, which are twice a month. And these are intended to be quick ideas that you can review and consume and be ready to use in 5 minutes or less. These are predominantly life insurance related, but we do occasionally do long-term care or annuity products as well. So with that, Brandon, can we open it up for questions?
We sure can, Michael. Thanks for all that outstanding information. And I'm going to remind our participants that if you'd like to ask a question, you may type that in the question box on the right side of your screen. And we have a lot of questions already, so we'll go ahead and get started. A couple of questions from Ray. He asks, what about wait and see, buy, sell? Could you tell us more about wait and see, buy, sell?
Yes, so the wait and see, buy, sell, at least my understanding of it, is a type of buy-sell agreement that doesn't specifically outline or address any way of identifying a value of this. It says we will determine at the time that this is triggered how much the business is worth. And there are a lot of businesses that like to do that because they can't exactly predict the growth or success of the business. And again, it's a big question mark. And it's an unknown. In my opinion, at least ensure what you know it's worth. So the wait and see, buy, sell, and let's back up a little bit. So when you're doing life insurance and disability insurance to find a buy-sell plan, you've got to document at that time what the business is worth. Now you can do the insurance without necessarily having an agreement to back it up. I would certainly recommend you have an agreement and that you have some sort of a formula on how to determine what that business is worth and ensure at least at the time that you set it up that amount or close to it. That way there's less that the business has to come up with at the time that that buy-sell agreement is triggered.
Excellent. And we also have a question about the attorney story that you were telling us earlier. The question is, why not make the attorney son the beneficiary of the survivorship policy?
In that situation, they could have certainly have done that, and they could have changed their estate plan to have the value of the farm go directly to the daughter and have the insurance go to the son. The advisor I was working with was more closely working with those clients than I was, so my understanding at the time is that the estate plan already said that the business, or excuse me, the farm was going to be distributed equally. So we were supplementing that plan with the life insurance. So rather than having them redo their estate plan, we just added the life insurance and that additional agreement between the two siblings to have that change hands at the time. I believe family farms are one of the types of entities where they get a step-up in basis which when inherited. So that was probably also a motivating factor that the sister was able to buy it basically for cost basis from her brother. So there was no taxable transfer for that transaction either.
We have a question. Can you make some comments about a wait and see provision in a buy-sell agreement? I think you've already answered that one, haven't you, Michael?
Yeah, I think so.
Perfect. And our next question is from Anson. Since a church does not file a tax return, which Form 8925 is to be attached, are they required to file Form 8925 if they have a key man life policy?
It's a great question. I've not had that one come up yet, so I'm going to have to kind of shoot from the hip on that. Because they do not file taxes, obviously, or if they do file taxes, they certainly don't pay income taxes as a tax-exempt organization. The same would be true of nonprofits. I'm not sure what the IRS's penalty would be for not filing an 8925. I would expect that they still want one, but like I said, I'm not sure if they have a penalty for that for tax-exempt entities.
All right, and Beth would like to know, what about a 162 bonus plan? Can't they be tax deductible to the employer?
I'm not as familiar with 162s. The way those bonuses work, it depends on how it can be set up. If you're using a qualified vehicle as a 162, then certainly that would be tax deductible. But if you're doing kind of the more simplified executive bonus like we described in the presentation, the tax deductibility of that works, assuming in that situation you've got the employer who's doing all the contributions to the plan, premiums in the event that it's funded by life insurance. Because that's not distributed to the employee, it wouldn't be considered taxable to the employee until they choose their distributions at a later date.
And our next question, a key person retires and would like to be the new owner of the life policy. What are the consequences, if any, to the employer and key person?
Great question. This gets into transfer for value rules. I have a piece, I don't normally send it out as a follow-up, but I will make a note, to attach it to the follow-ups that we send out that talks about transfer for value rules. So transfer for value rules as a broad topic refers to when any kind of an asset is passed from a business to an employee or owner of the business. So any asset at all, whether that's a life insurance policy or something else. And transfer for value rules dictate what the value of that transfer is. When that asset being transferred is a life insurance policy, term, permanent with cash value, what have you, there are certain exemptions to transfer for value rules that apply. The biggest one by far is, well, let me say there's two. The two big ones are if the asset, in this case a life insurance policy, is being transferred to someone who is the insured of that policy. That is an exemption to transfer for value rules. The second is if the transfer is occurring to an owner of the business entity. That policy is also exempt from transfer for value rules. And like I said, I've got a two-page piece that specifically addresses that topic. I'll make sure to send that out in our follow-ups.
What is a captive insurance company?
I was hoping somebody wouldn't ask that. So a captive insurance company, a very complex planning tool, and is applicable to a very, very small segment of businesses. So what a captive insurance company is you need a business who has a quantifiable, insurable risk that is not commonly insurable from the traditional market. And we're talking about not necessarily a life or disability or long-term care risk. It can be any kind of risk. So let me see if I can come up with a good example. Let's say a very large farming corporation. Think Monsanto as an example. And actually that might be a good example. Monsanto probably has a captive insurance company. So Monsanto could, for example, have a private insurance company. They set up a separate entity, usually a C Corp, to act as their private insurer. They pay premiums to that insurer to cover a specified risk. So in the case of Monsanto as a farming company, they could say, we want to insure against crop losses due to natural disaster, as an example. So they would have to hire an actuary to come up with a formula to determine how much premium they would have to pay to their private insurance company, their captive insurance company, to cover that risk. That captive insurance company, as a hedge on their own risk, can buy life insurance on the owners of and partners of Monsanto. That is one of the three exceptions we talked about where the life insurance premiums are tax deductible for that captive insurance company. And again, like I said, there has to be a clearly quantifiable risk that can be privately insured. You can't just set up a captive exclusively for the purposes of making your life insurance premiums tax deductible.
Excellent. And we have a follow-up comment from Beth. And in another context, we also, of course, have captive agents, State Farm, for example. So very true.
Yeah, sorry, the term captive, I wish we had a different term. So not to and Northwestern Mutual, New York Life, etc. Is it different than that?
All right, our next question. Dan would like to know, can a business transfer a percentage of ownership of a business-owned policy to the insured over a period of time, say 10% per year over 10 years?
If they were going to do that, they would probably want to do it from the get-go, and that's what we call a split dollar. And split dollar is where you're basically providing an economic benefit to the employee, but making a portion of the policy come back to the employer at claim time. So for example, in a common split dollar scenario, you would have an employer take out $1 million policy on their key person. The purpose of that policy is, of course, the death of that key person for the business. But let's say they only needed $500,000 as key person insurance. They could say to that employee, we know you need some additional coverage for yourself. We're willing to pay for it. So half of the death benefit is going to go to you. Even though we are paying the premium and we are 50% beneficiary, we are 100% owner. In the event of death of that person, $500,000 goes to their beneficiaries. $500,000 goes to the employer, but the employee would have been paying what's called the economic benefit tax all along, which is basically, it's a very complicated formula. Basically, it's what is the underlying cost of the $500,000 for that employee. But let me go back and answer your question a little more directly. If they're going to transfer a policy to the employee over time, you mentioned 10% per year over a period of time, they can certainly do that. I guess my big question would be, what is the purpose of transferring it over time rather than just doing it all at once? Because they're the insured, that's one of those transfer for value exemptions. There is no taxable impact when a life insurance policy is transferred to an employee who's the insured of that policy.
And the next question I'm going to tackle, can the slides be emailed to us? And the answer is yes. Michael has generously offered to share the entire slide deck with us. In addition to the slide deck, he'll also be emailing some other helpful follow-up documents. And that's not all. You're also going to get an automated webinar, an automated email from NAIFA Webinars organizer, and that's going to include the link to the recording of this webinar. So you can also watch the recorded webinar with the audio and video, and that link will be emailed to you within 2 business days. Next question, is there a fix if a client has not been filing Form 8925?
I guess that would depend whether or not they obtained the original notice and consent. If they had not done the original notice and consent, the only fix is to do a new policy. A policy cannot retroactively be made compliant if it was not compliant from the get-go. If they did do original notice and consent, filed their 8925, and then stopped filing their 8925, and again, this is going to be a little bit of guesswork, I would estimate, just like any other form you file with the IRS, if you start and then stop, there's a mechanism to catch up. I do not know what that is for an 8925. But I suspect that there is some sort of mechanism for that.
And Michael, could you please share some of your best prospecting ideas to get started in this line of business? Oh,
to get started in this business in general or in the business market?
The business market.
Okay. To get started, the best thing that I would do is talk to the people that you're already getting services from. So for example, one of my business owner clients is, and I guess it's not really a business owner client per se, but she's an executive, is the person who does my business banking. She's a business banking officer or business development officer with a small community bank. I'm a client of hers, she's a client of mine. So talk to the people you're already getting services from, and don't limit it to white collar services. Talk to the people who are doing, if you have a gardener or if you have a dry cleaner or anybody of those, or anybody you already know who owns a business or is in any kind of management position at a business, is the best places to start because you already have a relationship with them.
Excellent. And another question, under 101J, one of the safe harbor options was insured heirs who were the beneficiary. I thought if business was the owner and payer and the heirs were the beneficiary, the proceeds would be taxable.
That is correct. I'm glad somebody noticed that. When I first read that in the 101J documentation that the IRS has, it kind of caught me off guard too. I was like, this is not in line with what we already understand about taxation of life insurance proceeds. So, and one of the documents you'll get from me is going to be a white paper the IRS put out on 101J. And that specific section, it talks about that that's an exemption for 101J penalties, per se. But the next paragraph immediately following that says it doesn't necessarily make it income tax-free. It just means it's not going to be income taxable under 101J. It might be income taxable under a different IRS section.
All right, and for James, can you please discuss a cross endorsement and when to use it?
Cross endorsement, are you, James, are you referring to the cross purchase buy-sell agreement?
Well, what we're going to do is ask James to go ahead and just provide a little clarification as to whether it involves the cross buy-sell agreements. We'll hold off on that one. Our next question, assuming consent is the same as a signature, how can an employer purchase life insurance on an employee without their consent?
It's another great question. There is, to my knowledge, at least in the primary market, there is not a company out there that will insure an employee without their consent, or at least without their knowledge. There is one surplus lines and company which has a product called confidential insurable interest. It's a very unique product. They have very strict guidelines on when you can use it. It's the only way I'm aware of to insure someone without their knowledge. One of the examples they use is for a contentious divorce. So you've got a non-compliant divorcee who's not willing to be insured, but is required to by a divorce decree as an example. But as far as an employee consenting, you're right, they have to sign the application to go through the underwriting process, but for IRS purposes, that doesn't necessarily mean that they've also consented. Well, let me back up. So the consent requirements for that document, and you'll get a sample document in your follow-ups, is not only that they agree to the amount and that the employer is the owner, but the more important part, which they do not necessarily agree to by signing the application, is that they consent to be insured even after they've separated from employment. And that is not something a life insurance application is going to address. But it is something that is required by 101J.
And we do have some follow-up from James regarding his initial question on the, let's see what James has answered yes. So the cross endorsement does refer to what you initially thought it was, Michael, the buy-sell, I believe.
Okay, great. Thanks, James. I appreciate that. So when to use a cross-purchase versus an entity purchase. Cross-purchase is far more used in situations that are small businesses that have only two owners. If you've got a pair of business partners who have a small business, maybe no employees or only 2 or 3 employees, a cross-purchase is where they each own each other's policies. That is far more common in small businesses. Once you get into larger businesses or businesses with more than 2 owners, that's usually when you want to look at either an entity purchase or a trustee purchase. And some of that will also be dictated by whoever is setting up their buy-sell agreements. It may be due to some legal issue that they're aware of that they may recommend one way or the other. And actually another thing that comes up is in a cross-purchase, because the policies are not owned by the business entity, they're owned by the owners individually, it's not an asset of the business. So it may not be subject to the business creditors. However, nowadays, most creditors require a personal guarantee for any sort of business loan. So that would exempt that particular protection in that situation.
And we are about out of time. We do have a number of questions still in the queue. So, Michael, if you don't mind sticking with us for about another 3 minutes, and we're going to try to push through the rest of the questions, if that's all right.
Yeah. I'm available for a little bit longer, so that works.
All right, outstanding. A comment, I would say the wait and see predominantly has to do with whether the direct stock purchase or entity redemption is the preferred mechanics at the time of death. And that's a comment from one of our participants.
Yeah, it's another way, or another reason for using the wait and see buy sell is if they want to change how the ownership disclose when a change occurs, not necessarily just determining a value.
Next question, how does a IRC 303 redemption compare to an entity purchase by sell?
Now you're asking me a question on something I'm not recalling 303 off the top of my head. So
that's
can we come back to that and I will Google it?
Sure. We'll have that included in the email to you, Michael, so you can follow up later.
Okay.
Do you find that CPAs review or ask for Form 8925 when compiling records? Would CPA be prompted to ask if they see life insurance on the books or balance sheet?
I'm going to have to give an opinion on that one. I think all CPAs who are filing business returns, who sort of work for a business, should be asking. Does that mean they are? Absolutely not. I think the good ones probably are, and the rest are probably just not up to date on 101J. So if you run into a CPA who's unfamiliar with that, that's absolutely an opportunity to bring a value add as a center of influence for them, is to show them how 101J works and show them why they need to be doing it.
If you had a customer who is a business owner and has a key person they want to insure, do you recommend the business owner or key person be the owner of the policy, since you said the business itself should not be the owner?
It depends who the beneficiary is going to be. If it's a true key person where the business is looking to replace the loss of that valuable person, then the business should be the owner and beneficiary. If they're providing some sort of an ancillary benefit for the employee, then the employee should be the owner, and the employee should choose their beneficiary, and the employer should pay the premiums. And just bear in mind, those premiums are considered part of the employee compensation, so they can pay taxes on that, but it's just on the premium, and that protects the death benefits taxation. I have also seen cases where you had a particularly generous employer who say, we'll pay the premiums, and we will gross up your compensation to cover the taxes on those premiums.
If a business owner retires and has a life insurance policy on him, and the business is the owner and payer, but he doesn't want or need the death benefit, what are the tax consequences to transfer the cash value into an annuity?
If you transfer it to an annuity, provided that the company is still the owner along the whole way, it simply is a asset of the company. Just like with anybody else, if an individual transferred cash value from a life insurance policy to an annuity, that is a tax-free transfer under Section 1035, and it does not become taxable until they start taking distributions from the annuity.
Can you please provide the web address to get on the distribution list for emails?
Yeah, let me back this slide up. There you go.
Excellent, and I'm sure this will also be included in the slide deck that you'll be providing, Michael, as well as the in the email that you'll be sending out to the participants.
Absolutely.
All right. Just a couple more questions, and then we'll wrap things up. Section 162 bonus plans classify premiums as compensation, and thus are tax deductible, and this treats the compensation as income. So a comment on Section 162 bonus plans.
Okay.
And we have, what way have you found is a simple way to show a visual of how exit/succession planning works to initiate that conversation with an owner?
Can you repeat the question? I want to make sure I fully grasp it.
Sure. What ways have you shown to visually demonstrate the business succession plan?
So this is going to be a little bit off the cuff. If you would like to use my slides for some of these as inspiration, by no means can I authorize cutting and pasting, but if you want to use them for inspiration, you're certainly welcome to do that when I send it out. But as far as illustrating it to a business owner, Probably one of the most effective ways that I've seen over the years is talking about, or if you want to put it into some sort of other visual format, is talking about with the business owner what they want the business to look like when they're not able to be at the helm anymore. And that gets them thinking about their legacy. What do they, if they look at it as simply, oh, this is just my retirement and I don't care what happens after I'm gone, then that tells you what route to go with the planning. But if it's a family business, most business owners who are expecting to turn the business over to family, it becomes a very emotional conversation with them about what they want the business to look like when they're not there anymore, or when they choose to step away. That gets them thinking about aspirations for their own children who are going to take over. That is also true in businesses that are not necessarily family owned, but where you have key people who are not yet owners, but who are expected to take over at some point down the road when the business owner is no longer able or willing. There's I'm going to mention a specific company out there, and I don't mean to give them an endorsement, but they have fantastic content. There's I think they're in New Jersey, somewhere in the Northeast. They have a system called Business Killers, and they produced a number of videos that talk about and illustrate. They've got actors who put together these videos that talk about what happens when a business owner dies. For example, one of their videos is showing the surviving spouse having a meeting with her deceased husband's business partner and talking about her financial concerns, about that there was no life insurance in place, and how she needs money from the business to live and support her children. There's another video that shows a family meeting talking about a multi-generational family business and how, without planning, the loss of that patriarch or matriarch of the business impacts the family and who wants the business and who needs revenue from it and how the surviving spouse is supported. So there are resources like that out there. Obviously those have some expense to them, but the content that is out there is phenomenal.
Excellent. I know that we're keeping our participants overtime and that Michael's working overtime, so we appreciate that. If you have to go, these questions will, of course, be included in the webinar recording that you'll be receiving. But we're going to wrap up with this last couple of questions. Do you give, rent, or sell our email addresses?
No. Any emails you get will be from us only, and you can certainly opt out at any time.
Excellent. And to wrap things up, all these solutions involve a financial professional, CPAs, and lawyers. Any suggestions on finding business partners?
The first place that I would go to is your NAIFA colleagues. If you meet someone in NAIFA who you respect or trust, ask them who they're using. And if they don't have an answer, then there are certainly other NAIFA members who are available. I know my local association here in Seattle, we are reaching out to other professionals in CPAs and legal professionals, trying to, especially using the pilot program, to bring in new members from other segments of complementing industries. I'm very happy to say we're bringing on a CPA as the treasurer for our local, which is going to be a huge relief for myself and my vice president. We're very happy about that.
And our very final question, referring back to the cross endorsement, it is another buy-sell that is being marketed versus the cross purchase or entity purchase. Have you heard of this concept?
I'm going to take a stab at what I think they're referring to. If they're talking about a cross endorsement, they might be referring to doing split owner and beneficiaries where you have more than two business owners. So back in the example where I was talking about 4 business owners, each going out to purchase 3 policies on their 3 business partners. You can do that with multiple owners and multiple beneficiaries. I've seen that done. One of the reasons I don't recommend it is because then anytime you need to make a change, you have to get however many signatures there are for owners of that policy. You can't just have one of them sign to make a change. You need all 3 of the other partners to sign to make a change. I hope that addresses that question.
It sure does, and we have been able to get all of your questions answered, and I want to thank our participants for participating on the webinar today and for all of your very interesting and insightful questions. And I want to thank you, Michael, for presenting on this fascinating topic. And I'd like to remind all of you that to access today's presentation, please use the web link that will be provided in the automated follow-up email that you'll be receiving within 2 business days. And thanks again for joining us today. This concludes the NAIFA webinar.